People often ask the wrong question first. They ask, should I start with stocks or should I start with real estate? That sounds like a financial question, but very often it is actually an emotional question. The person is not really asking which asset class fits the system best. He is asking because he has recently seen someone else make money. A friend bought a rental property and now seems smart. A coworker bought stocks and now talks about gains. A neighbor renovated a house and made a profit. Someone online showed screenshots of a portfolio. Suddenly, the person who had no interest in that investment yesterday feels an urgent need to act today. That is how human psychology works. The thing was always there, but it was not relevant to the mind until attention attached itself to it. There is a name for this. It is called the frequency illusion, or the Baader-Meinhof phenomenon. You think about buying a certain truck and suddenly you see that truck everywhere. The trucks were always there. Your brain only began tagging them as important. The same thing happens with investing. You hear about real estate making money, and suddenly every successful person seems to own rental houses. You hear about stocks making money, and suddenly every chart looks like a missed opportunity. You hear about dividends, and suddenly you notice companies paying dividends. The world did not change, your attention changed. This is why the first principle is not to chase what recently became visible. The first principle is to ask why it became visible to you. Now, are you acting because the asset fits your plan? Or are you acting because your attention was captured by somebody else's result? That distinction can save a lot of money. I have spent my life studying systems, and one of the most important things I have learned is that wealth is built less by chasing excitement than by placing decisions in the correct sequence. Stocks and real estate can both build wealth. Both can be excellent. Both can also hurt you badly if used in the wrong way at the wrong time with the wrong structure. The question is not which one is morally better. The question is, where should a beginner start if the goal is to build competence, liquidity, and resilience before taking on larger and more complex commitments? For most beginners, I would start with stocks, not because real estate is bad. Real estate can be one of the most powerful wealth-building tools in the tax code, but the sequence matters. And for a beginner, stocks provide something real estate often does not provide at the beginning. They provide liquidity. They provide smaller mistakes. They provide a faster learning loop. They provide exposure without the same level of operational risk. And just as important, they create skin in the game. Skin in the game changes the way the brain learns. If I try to teach someone about a company before they own it, the information is often abstract. Revenue, earnings, valuation, dividend, date, PI ratio, free cash flow, balance sheet. The words may be understandable, but they do not feel alive. But the moment someone owns even a small number of shares, the same information becomes relevant. If you own Coca-Cola, you start noticing Coca-Cola. You notice the products in stores. You notice earnings. You notice dividends. You notice how the stock reacts to news. You notice valuation. You notice the business model. You begin to connect the abstract to the real. That is how competence begins. Not by watching 10 more random videos. Not by reading endless opinions online. Not by copying the most confident person in a comment section. Competence begins when ownership makes the information matter. This does not mean you buy blindly. It means you start small, start deliberately, and let the ownership create attention. The source document makes the point that around 20 hours of focused effort can make someone competent at a basic level in many fields. Not expert competent, that matters. In investing, competence does not mean you know everything. It means you are no longer guessing blindly. It means you can ask better questions. It means you understand what a dividend is. It means you understand why liquidity matters. It means you know that a stock price and business value are not the same thing. It means you know that real estate cash flow is not the same as rent collected. It means you can avoid the most obvious mistakes. That is the first goal. Do not start by trying to become rich quickly. Start by becoming competent enough not to blow yourself up. That is why stocks are often the better starting point. If you buy shares of a stable dividend-paying company and you are wrong, the worst case loss is usually limited to the capital you invested in that stock. That is painful. But it is bounded. If you buy a rental property and you are wrong, the loss can exceed the money you thought you invested. The tenant can stop paying. The tenant can sue you. There can be mold, the roof can fail, the air conditioner can die, the property taxes can jump, the tenant can damage the house, the market can decline, the property can sit vacant, you can owe the mortgage while the property produces no income. The mistake is not only the asset falling in value, the mistake can become an ongoing obligation. That difference matters. A stock can go down, a rental property can demand more money from you when you are least prepared. That is why real estate can be dangerous for someone whose entire cushion is tied up in the down payment. The problem is not real estate. The problem is fragility. If you buy one rental with almost all your available capital, you have no margin for error. And in real estate, errors and surprises are not rare. They are part of the business. A roof is not an emergency. If you plan for it, a vacancy is not an emergency. If you reserve for it, a bad tenant is not a disaster. if you have capital process, insurance, legal structure, and experience. But for a beginner with little liquidity, the same ordinary event can become a crisis. This is why I always start with the risk structure of the asset. Stocks are more volatile in price. Real estate is more operationally complex. Stocks show you the pain every day on a screen. Real estate often hides the pain until the bill arrives. Beginners often think real estate is safer because they can touch it. That is an illusion. Touching an asset does not mean understanding it. A house is easy to understand as a place to live. It is much harder to understand as an investment system. A rental property is financing, market selection, tenant screening, property management, insurance, vacancy, maintenance, capital expenditures, legal structure, local law, taxes, depreciation, repairs, cash flow, and debt service. That is not one decision. That is a machine if you do not understand the machine. The machine can hurt you. Stocks have their own machine too, but the early learning loop can be smaller and more forgiving. You can buy a small position, you can watch it, you can study earnings, you can learn dividends, you can learn options carefully if appropriate, you can sell if you need liquidity, you can make mistakes without tying your entire financial life to one illiquid property. This is why I like the sequence. Start with stocks to learn how capital works, then move into real estate when you have more capital, more competence, and more reserves. Eventually, a well-built wealth system may include both. But the path matters. The source document uses a model that can be understood as 30-30-30-10, 30% in income, producing stocks, 30% in real estate, 30% in managed money or investments where someone else is making the decision or where the exposure is more diversified and less dependent on your daily judgment, 10% in cash or cash equivalents. This is not a universal law. No allocation rule is perfect for everyone, but the framework is useful because it teaches the most important principle. Do not put your whole life into one bucket. Concentration can create wealth if you are right, but concentration can destroy wealth if you are wrong. Most beginners concentrate unintentionally. They put everything into the first thing that excites them. One property, one stock, one crypto asset, one strategy, one market, one friend's idea. Then a cycle turns and they discover that they were not investing, they were exposed. Diversification is not a lack of conviction. Diversification is recognition that the future has more than one possible path. That is why the 30-30-30-10 model can be useful. The stock bucket teaches liquidity and income. The real estate bucket gives exposure to property, leverage, tax advantages, and inflation. Sensitive assets, the managed money bucket reduces dependence on your own decisions. The cash bucket gives you dry powder and protection. Cash is not there because cash is the best long-term asset. Cash is there because liquidity is oxygen. When an opportunity appears, cash lets you act. When a problem appears, cash lets you survive. When a market crashes, cash turns fear into possibility. Without cash, the same event that should be a chance to buy becomes a forced sale. That is why the cash bucket is not filled last. It is built along the way as capital grows. Cash should grow with it. If you have $50,000 invested, you may want a cash buffer near it depending on your personal life and the model you follow. If you have $1 million portfolio, 10% cash or cash equivalents means $100,000 of flexibility. That flexibility matters. Now let us examine the stock bucket more carefully. The source document focuses on income, producing stocks, especially dividend-paying companies. This is important because the objective is not gambling. The objective is to learn quality. A beginner should not start by buying a rumor from a brother-in-law at the gym. A beginner should not start by chasing speculative stocks because someone online says they will explode. A beginner should start with companies that have durable businesses, long operating histories, and a habit of paying shareholders. Dividend aristocrats and dividend kings are useful categories. A dividend aristocrat is a company that has increased its dividend for at least 25 consecutive years. A dividend king has increased its dividend for at least 50 consecutive years. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble are often used as examples of businesses that have survived many cycles and continued paying shareholders. This does not make them risk-free. No stock is risk-free, but they can be a good training ground. Why? Because dividends force the investor to think like an owner. The business earns money. Some of that money is returned to shareholders. If the dividend rises over time, the investor can begin to see how business quality, cash generation, and long-term ownership connect. The source document describes wanting to get paid in multiple ways from a stock. Get paid through cash-secured puts if used properly. Own the stock and receive dividends, sell covered calls if appropriate. Potentially make gains when selling the stock. This is more advanced than simply buying shares, and a beginner should not rush into options without understanding them. But the principle is useful. A stock can be more than a price chart. It can be a cash flow instrument. It can be an ownership instrument. It can teach discipline. It can teach valuation. It can teach market behavior. But only if you approach it systematically. The source document uses a 7-point filter for dividend stocks. Does the stock yield more than 2%? Is the dividend trending upward? Is the stock in a stable or upward channel rather than a falling knife? Does it have options so covered calls may be possible? Has the dividend been consistent for at least 10 years? Is revenue stable or growing? Is the P/E ratio reasonable? Perhaps in a range such as 15 to 25. Are analysts more positive than negative, using a ratio like 3 positive views for every negative view? The exact filter can be debated, but the logic is right. Do not buy randomly. Create criteria. Criteria reduce emotion. Criteria make you ask whether the business deserves your capital. This is one of the most important habits a beginner can build. Without criteria, every investment idea feels possible. With criteria, most ideas are rejected quickly. That is good. The goal is not to buy many things. The goal is to buy things that fit a well-understood system. A dividend stock passing a quality filter gives the beginner a practical education. You learn what yield means. You learn what dividend growth means. You learn what valuation means. You learn what revenue stability means. You learn how options can create income if used properly. You learn how markets price stable companies. You learn how boring businesses can build wealth. You learn pattern recognition. Pattern recognition matters. A person who owns and studies stocks begins noticing how companies behave through earnings, recessions, rate cycles, and market corrections. That experience is hard to get from theory alone. Now, let us be very clear about real estate. I like real estate. Real estate can be extraordinary. The tax code loves real estate in ways that many people do not understand. Depreciation can shelter income. Bonus depreciation may create large deductions in certain situations. Leverage can magnify returns. Control can be high because the owner can improve operations, raise rents, reduce expenses, renovate, refinance, or restructure. A 1031 exchange can defer taxes when moving from one property to another. A step up in basis can reduce or eliminate capital gains for heirs under current rules. The buy, borrow, die strategy can be powerful for people with the right assets and estate plan. Real estate is one of the great wealth building systems when used properly, but that does not mean it is the best first move for an undercapitalized beginner. A powerful tool can be dangerous in weak hands. The problem is not the tool. The problem is the mismatch between the tool and the person's level of capital knowledge and resilience. I have seen people save $20,000 or $30,000, watch a few videos, and buy a cheap rental in a market they do not understand. They think they are becoming investors. Then the tenant stops paying, the air conditioner fails. The roof leaks, insurance rises, property taxes increase, the property manager performs poorly. The local laws make evictions slow, and suddenly the person realizes that the down payment was only the beginning. The property needs more money, but the person has no more money. That is how beginners get hurt. They believe they were buying cash flow. They were actually buying a business. They did not know how to operate a rental property as a business. If you do not treat it that way, it will teach you, often expensively. This is why underwriting matters. The source document gives a simple rental example. If a property rents for $1,500 per month, do not assume you keep $1,500. That is one of the most common beginner mistakes. Rent is not cash flow. Rent is gross income. From that gross income, you must pay taxes, insurance, maintenance, management fees, vacancy, repairs, capital expenditures, and other costs. A conservative rule of thumb may assume that roughly half the rent disappears before debt service. If $1,500 comes in, perhaps $750 is the rough net before paying the mortgage. That $750 still has to cover debt service. If the mortgage and related debt payment exceed that amount, the property may be negative cash flow. That may be acceptable in certain strategic situations for a highly capitalized investor with a specific plan, but it is dangerous for a beginner who believes the property is producing income. If the math does not work, do not do the deal. That sentence is simple. It is also one of the most valuable rules in investing. If the math does not work, do not do the deal. Do not let excitement make the math work. Do not let a realtor make the math work. Do not let a YouTube personality make the math work. Do not let future appreciation assumptions make a bad current cash flow deal. Look acceptable. Appreciation can happen. But if appreciation is the only reason the deal works, you are speculating, not investing for cash flow. Speculation has a place for some people, but do not confuse it with a conservative rental. Now, if a person is strongly interested in real estate early, there are smarter entry points than buying a distant rental with no reserves. One is house hacking. House hacking means buying a property you live in while renting part of it to others. It might be a single-family home with extra rooms, it might be a duplex, it might be a triplex, it might be a small multifamily property where you live in one unit and rent the others. This can work because you needed housing anyway. The rental income helps offset the mortgage. You learn landlord skills with training wheels. You are close to the property. You see the issues. You develop competence without immediately jumping into a large remote operational investment. House hacking is not risk-free. You still need reserves. You still need to understand tenants, leases, local law, maintenance, and insurance. But the structure can be much better for a beginner than buying a random rental far away. Another early real estate strategy is the live, an improvement strategy. This means buying a primary residence that needs work, living in it, improving it, and later selling it. The tax code allows an exclusion on capital gains for a primary residence if you meet certain ownership and use requirements. Generally, if you live in the home for 2 of the last 5 years, you may exclude up to $250,000 of gain if single or $500,000 if married filing jointly. That is a powerful tax benefit. It allows someone to improve a home, build equity, and potentially sell with a large gain excluded from federal tax done repeatedly over time. This can build capital without the same tenant risk as a traditional rental. Again, it is not effortless. Renovations cost money. Projects can run over budget, markets can change. But if the person needed a place to live anyway, the strategy can combine utility and wealth building. A third early real estate exposure is REITs. Real estate investment trusts allow someone to own real estate exposure with the liquidity of publicly traded securities. REITs can pay dividends. They can expose you to apartments, industrial properties, shopping centers, data centers, medical offices, cell towers, storage, or other real estate sectors. They are not the same as owning a property directly. You do not control the asset. You are exposed to market volatility. Interest rates can affect valuations, management matters, but REITs can teach how real estate behaves without trapping all your money in one property. For someone still building capital, this can be a useful bridge. You can learn about occupancy, funds from operations, debt maturities, property types, lease structures, interest rate sensitivity, dividend sustainability, and real estate cycles. And if you need liquidity, you can sell the shares. That is a very different risk profile from owning a house that may take months to sell. This is why sequence matters again. Stocks teach market behavior and liquidity. REITs can teach real estate economics with more liquidity. House hacking or live-in improvements can teach operational real estate with a personal use layer. Direct rental ownership becomes more appropriate when capital reserves and competence are stronger. Now let us talk about managed money in the 30-30-30-10 model. The managed money bucket is meant to reduce dependence on your own decisions. This can mean hiring a manager if the portfolio is large enough. It can mean broad ETFs. It can mean mirroring a diversified portfolio. It can mean syndications or structures where another operator is making the day-to-day decisions. The point is psychological and structural. Many do it yourself. Investors become overweight in the one thing they understand or the one thing that recently worked. Then a cycle turns. Stocks fall 38%, housing collapses, a sector gets hit, a tenant problem appears, a concentrated bet goes wrong. If everything depends on your own judgment in one area, the portfolio is fragile. Managed money, broad ETFs, or diversified professional exposure can reduce that fragility. This does not mean you blindly trust someone else. You still need due diligence. Managers can be expensive. Syndications can be illiquid. ETFs can overlap. Fees can compound against you. But the idea of decoupling part of your portfolio from your own daily decisions is valuable. A good financial system should not require you to be brilliant every day. It should be robust enough to survive ordinary human imperfection. That is what allocation is for. Now, there's another cognitive problem in the source document that deserves attention. Man amnesia. This is the tendency to notice that media coverage is wrong or oversimplified in a field you know well, and then forget that lesson when reading coverage in a field you do not know. If you are a tax expert and read an article about tax, you may see errors immediately. Then you turn the page and read an article about real estate, medicine, geopolitics, or investing, and you assume it is accurate. That is dangerous. The same applies to AI tools. AI can hallucinate. It can produce confident answers that are wrong. If you already understand the field, you may detect the error. If you do not, you may accept it. This is why investing based on internet summaries is risky. The person writing may not be an expert. The AI answer may not be correct. The article may oversimplify. The promoter may not be doing the strategy personally. The video may highlight the best case scenario and ignore the operational risks. You must use systems and numbers, not hype, not borrowed confidence. In stocks, that means looking at earnings, dividends, balance sheets, revenue, valuation, and risks. In real estate, that means underwriting rent, expenses, debt service, reserves, legal structure, tenant risk, maintenance, insurance, taxes, and exit options in taxes. That means getting proper advice rather than trusting a viral shortcut. The more complex the strategy, the more dangerous oversimplified information becomes. This is why beginners should not start with the most complex version of an asset class. Do not start with advanced options. Do not start with a distressed out of state rental. Do not start with a highly leveraged syndication. Do not start with tax strategies you do not understand. Start with competence, then increase complexity. This is a principle in every domain. Complexity should be earned. Now, what is the proper sequence? The source document gives a clear path. Start with stocks. Use dividend, paying companies as a training ground. Build liquidity, build pattern recognition, learn how money behaves, understand cash flow, understand valuation, understand that owning something changes attention. then move into real estate more intelligently, maybe through REITs, maybe through house hacking, maybe through live in improvements, maybe later through direct rentals when you have reserves as capital grows. Move toward a broader allocation income producing stocks, real estate, or real estate equivalents. Managed money or diversified exposure, cash or cash equivalents. That is a system. It is not glamorous. It is not based on chasing what your friend just made money in. It is built on learning liquidity, cash flow, diversification, and risk control. That is how lasting wealth is built. The word lasting is important. There are many ways to make money temporarily. The financial world is full of people who made money fast and lost it faster. Lasting wealth requires a different machine. It requires survival. It requires liquidity. It requires diversification. It requires tax awareness. It requires asset protection. It requires humility. It requires a willingness to learn before scaling. Many people want the wealth of Chapter 20 while they are still in Chapter 1. That is how they get hurt. You cannot copy someone else's later stage strategy if you do not have their capital base experience, team, reserves, tax structure, or risk tolerance. A wealthy real estate investor with 50 properties can survive a bad tenant. A beginner with 1 property and no reserves may not. A sophisticated options trader can use strategies that would destroy a beginner. A wealthy investor can hold illiquid assets for years. A beginner may need the money in 3 months. Context matters. An investment is not good or bad in isolation. It is good or bad relative to the investor's situation. This is why I ask, why are you asking now? If you are asking because you have a plan and the next step is real estate, that is one thing. If you are asking because someone else made money and now you feel behind, that is another. Financial decisions made from envy are often expensive. Envy makes you skip steps. Envy makes you underestimate risk. Envy makes you copy without context. Envy makes you think someone else's outcome proves the asset is easy. It rarely is. The disciplined investor does not ask, what is everyone else making money in? He asks, what is the next best step for my system? If your system lacks liquidity, stocks and cash may matter more than real estate. If your system lacks real asset exposure and you have reserves, real estate may become more appropriate. If your system is too dependent on your own decisions, managed money or broad ETFs may help. If your system has no dry powder, cash must be rebuilt. Each stage has its own correct move. That is the essence of sequencing. Now, let us think about liquidity more deeply. Liquidity is often underestimated by people who are excited about assets. They want all their money working. Cash feels lazy. A rental property feels productive. Stocks feel productive. Crypto feels exciting. But cash is what prevents assets from becoming prisons. If you need money and all your capital is inside an illiquid rental property, you may be forced to borrow, sell at a bad time, or take on credit card debt. If you need money and your stocks are down but you have no cash, you may be forced to sell at the wrong moment. Liquidity protects the rest of the portfolio. It is not a sign of weakness, it is a margin of safety in real estate. Liquidity is especially important because the asset can require unexpected capital. A roof does not care whether your savings account is ready. A tenant vacancy does not wait for a convenient month. A lawsuit does not arrive when the market is strong. So if you buy real estate, you need reserves. The property's emergency fund is not the same as your personal emergency fund. A beginner often confuses the two. That is dangerous. The property should have its own reserves for vacancy, repairs, capital expenditures, insurance deductibles, legal costs, and unexpected events. If the property cannot support reserves, or you cannot supply them, the deal may be too risky. Now, let us think about cash flow. The source document uses a phrase that is useful. Buy the chickens and eat the eggs. Do not eat the chickens. That is a simple way to explain cash flow investing. The asset is the chicken. The income is the egg. If you sell the asset every time you need money, you are eating the chicken. If you own assets that produce income and you live partly from the income while preserving the asset, you are eating the eggs. Dividend stocks can teach this, REITs can teach this, rental properties can teach this, bonds and municipal bonds can teach this. The goal is to build assets that create recurring cash flow, but recurring cash flow must be real. A dividend that is not supported by earnings can be cut. A rental that does not cover true expenses is not cash flow. A covered call strategy used incorrectly can cap upside or create unwanted assignment. A high-yield asset can be high yield because it is high risk. So again, competence matters. Income is good only if it is durable, understood, and appropriately priced. Now, let us discuss municipal bonds briefly because the source document mentions that some investors dismiss them as too low return. Return must be viewed after tax. A tax-free municipal bond yielding 4.5% may be equivalent to a much higher taxable yield for someone in a high tax bracket. For a high-income investor, tax-free income can be very valuable. For a lower-income investor, the benefit may be less important. Again, context matters. The same asset can be attractive or unattractive depending on the investor's tax situation. That is why tax awareness is part of wealth building. Returns are not only what the asset earns, returns are what you keep after taxes, fees, inflation, and mistakes. Many investors focus too much on headline return and too little on retention. Wealth is not what passes through your hands. Wealth is what remains and compounds. Taxes, fees, bad debt, poor structure, and forced selling all reduce what remains. That is why the source document's emphasis on tax strategy and asset protection is not incidental. Real estate has tax benefits, but those benefits are most useful when the investment itself is sound. A tax benefit does not rescue a bad deal. Depreciation is valuable, but negative cash flow and operational failure can still destroy you. A 1031 exchange is powerful, but it requires planning. Asset protection matters, but legal structures do not remove the need to buy correctly. You cannot use complexity to hide from weak fundamentals. The math must work first, then tax and legal structure can improve the result. Now, what does a good beginner path look like in practice? A person begins by building an emergency fund, then they begin buying a small basket of quality dividend, paying stocks or broad low-cost ETFs. They learn how statements work, they learn what dividends are, they learn what valuation is, they learn how markets move, they perhaps learn options slowly. Only after understanding the risks, they build up a meaningful stock bucket, they keep cash on the side. They do not use every dollar, they avoid high-interest debt. Then they begin studying real estate, not buying immediately, studying rent levels, markets, insurance, vacancy, property taxes, property management, tenant laws, roof life, HVAC costs, CapEx, debt service. They may start with REITs to learn. They may consider house hacking if their life situation fits. They may use the live in improvement strategy if they are willing to renovate and move. Only when they have capital reserves and a clear underwriting process do they buy direct rentals. This is slower. It is also safer. A person who moves slowly in the correct sequence can outperform someone who rushes into the wrong asset at the wrong time. With no reserve, speed feels impressive. Survival compounds. Now, let us address the common objection. What if real estate is going up and I wait too long? This is the fear of missing out. It affects stocks and real estate. The answer is that missing one opportunity is not fatal. Getting wiped out by one poorly structured deal can be. The world always creates new opportunities. A person with capital, liquidity, and competence can act when opportunities appear. A person who rushes into a bad deal because of fear may lose the ability to act later. Opportunity cost cuts both ways. Waiting too long can cost money. Acting too early without competence can cost more. That is why the right approach is not endless waiting. It is deliberate preparation. Prepare until you can act intelligently, then act. Do not wait for perfection. Do not rush from envy. That is the balance. Now, let us think about how this applies to $1 million portfolio. If someone has $1 million, a 30-30-30-10 structure would mean roughly $300,000 in income. Producing stocks or similar income assets, $300,000 in real estate or real estate equivalents, $300,000 in managed money or diversified strategies, and $100,000 in cash or cash equivalents. The exact numbers can be adjusted, but the shape is useful. There is no single point of failure. The person has exposure to businesses, exposure to real estate, exposure to diversified or managed allocation. Liquidity. If stocks draw down, real estate and cash may help. If real estate has problems, stocks and managed assets may help. If an opportunity appears, cash is available. If personal life creates a need, cash prevents forced liquidation. That is how a portfolio becomes resilient. A resilient portfolio may not always have the highest possible return in a bull market, but it has a better chance of surviving multiple environments. And survival is what lets compounding continue. Now, for someone with less than $150,000 in investable assets, the model may look different. The priority may be building competence and liquidity rather than instantly recreating the final allocation. If you have $50,000, putting it all into one property may be dangerous. Putting part into stocks, keeping cash, and learning may be wiser. If you are still below that level, focus on the foundation. Earn more, save more, avoid toxic debt, build cash. Start investing small, learn, then scale. Do not be ashamed of starting small. Small is how real competence begins. The person who starts small and studies can become much stronger than the person who starts big and guesses. In markets, the size of the first move matters less than the quality of the learning loop. Now, let us revisit the core psychological lesson. The frequency illusion can be harmful, but it can also be used constructively. If you buy a small piece of a quality company, your brain begins paying attention. This is a good use of the phenomenon. You are not letting it push you into a reckless decision. You are using small ownership to activate learning. The same can be done with REITs before buying real estate. Own a small amount, study the sector, learn how interest rates affect it, learn how rent, occupancy, and debt matter. Use ownership to make the education relevant. This is much better than passive consumption of information. Most people consume financial content without changing their behavior or competence. They watch videos, they hear opinions, they feel smarter for a moment. Then they move on. Owning a small amount of a real asset changes the learning. It makes the lesson sticky. But the ownership must be sized so that a mistake is educational, not catastrophic. That is the key. Make mistakes small enough to survive, then make better decisions as competence grows. This is how professional learning works in many fields. Pilots do not start with the most complex aircraft in a storm. Doctors do not begin with the hardest surgery alone. Investors should not begin with highly leveraged illiquid assets they barely understand. Start where mistakes are survivable, then build. Now, the final principle is that wealth building is not about choosing stocks forever or real estate forever. It is about building a system where each asset class plays a role. Stocks provide liquidity, market exposure, dividends, growth, and learning. Real estate provides tangible assets, leverage, tax benefits, cash flow potential, and inflation sensitivity. Managed money provides diversification and reduced dependence on your own day. Today decisions, cash provides optionality and protection. A good system knows the strengths and weaknesses of each. Stocks can be volatile and psychologically stressful. Real estate can be illiquid and operationally demanding. Managed money can have fees and manager risk. Cash loses purchasing power if held excessively in inflationary environments. Nothing is perfect. That is why balance matters. The right question is not, which asset is perfect? The right question is, how do I combine imperfect assets into a resilient system? That is how I would think about stocks versus real estate. Start with the asset that helps you learn with liquidity and smaller errors. Use dividend stocks or broad quality exposure to build competence. Do not rush into direct real estate until you have reserves and underwriting skill. Use REITs, house hacking, or live in improvement strategies as more controlled bridges. If real estate is important to you early over time, build toward a diversified model. Keep cash, protect liquidity. Let each bucket serve its function. Do not copy another person's chapter 20 when you are still in chapter 1. Do not let someone else's success create your urgency. Do not confuse visibility with opportunity. Do not confuse touching an asset with understanding it. Do not confuse gross rent with cash flow. Do not confuse tax benefits with a good deal. Do not confuse a stock price decline with a permanent loss if the business remains sound. And do not confuse learning with watching. Learning happens when you engage with the asset, study the numbers, and make decisions with consequences. That is how competence is built. And competence, compounded over time, is one of the greatest assets an investor can own. The stock market can teach you. Real estate can enrich you. Taxes can protect you. Cash can save you, but sequence is what keeps you from being destroyed while you learn. So if you are asking where to start, I would begin with stocks, not as the final destination, as the training ground. Then when your liquidity, competence, and reserves are stronger, real estate becomes much more powerful. That is how you build wealth that lasts. Not through excitement, through order. Not through envy, through principles. Not by chasing what just became visible. By building a machine that can survive mistakes, capture cash flow, reduce taxes, diversify risk, and keep compounding long after the first decision is made.